Hello class, welcome to our 15th lecture series on financial accounting, and I am your instructor Jamal Haider. So today is our 15th lecture series, which is the last lecture. And remember, our final exam is going to be on 29th of October. Sorry about because my pen is not working properly. So our final exam is on December 29th. And regarding the paper pattern, it is the same as our midterm pattern, in which we talked about that there's going to be a part one, which is uh, consisted of like true, false, MCQs question, and of course it would be time restricted. So I would be also uploading its solution file. All you need to do, put the answer there, respect the time limit, and send it to my WeChat ID. Or you can email me, but I would prefer the WeChat ID because then you can send the solution file in time, and in email maybe I receive email after 1 hour or maybe 30 minutes, then it really gonna be difficult for me to assign grades because I won't be allowing anybody to violate the time restrictions because this is the online exam and I need to minimize the opportunity, the window of opportunity uh, for cheating. Okay, I hope you respect that. For part two, there's gonna be ample time for you guys to fill it out. So mostly I would be giving you entries like we did in our last lecture. We talked about the discount, and today we'll talk about the premium as well. So these kind of entries and fairly not very long questions, but mostly related to entries, calculating the depreciation, this kind of stuff. Okay, but accounting treatment gonna be of course there. I would be asking entries as well. Okay, and remember, the exam is of 30% of your OLR evaluation. Okay, let's move. Now we will start about accounting for bonds payable issued at premium. So premium means when the company receives cash more than its issuing value or face value, right? Okay, so let's understand it by an example. On January 1st, 2014, Southwest Airline issued 100,000 of 9% 5-year bond where the market rate is 8%. How you know that this is premium bond? Because you are paying higher, the company is paying higher, and market rate is lower. So what was the tagline? Tagline was that when coupon rate greater than the market rate, then bonds are issued at premium. So the proof is that they received more than issuance, right? So company received this value, right? Cash is received. Answer would be cash 104 100, right? And company need to pay back the money. How much? 100,000. So the excess amount is called premium, and premium is recorded as credit. Increase in premium means credit, right? So it is the opposite of the discount, which means it start decreasing from the interest payments, which means interest expense. So in that case, our interest expense will be lower than interest payments. Why? Because the the value of the bond must be equal to the maturity value at the end of 5 years, right? It start to decrease. In case of discount, it has to increase to the maturity value. So the accounting equation is not disturbed. Why? Because we have cash, which is 104,000. Liability, we have to pay this one, and this is also we treat this premium as a reserve, or because it's also payable, we receive in advance, so we'll adjust it into paying back our interest. So how we write it on the balance sheet? We write it on the balance sheet as bond value plus the premium. In case of discount, we write it down here negative, right? But here is a plus. So bond value right now is more than issuing balance. So it means after 5 years this will decrease to 100,000, right? This will decrease. Okay. So let's talk about how we calculate the interest payments and interest expense. So remember, interest expense is always based on market value, and interest payments are always based on coupon rate or stated rate. So interest payments is calculated as 9% annually, which is 4.5%. It's 9% semi-annually, which is 4.5%. So 4,500. While the interest expense is based on market value multiplied by this market rate, 4% annually, semi-annually, or 8% multiplied by 6 by 12. So did you notice something? Here interest expense less than interest payments, right? Did you notice something? The interest expense that would go to income statement is lower than what we actually pay. So it means what we have received in excess, we will retire this. This is for 5 years. We will slowly, parts of this 4,100 will going to be retired slowly, and we're going to be adjusting it into our interest payments. So that's why our interest expense are lower, right? So at the end of the year, maturity year, the value of the bond has to decrease to face value. In case of discount, it will increase to bond value. In case of premium, it will decrease to bond value. So 4,500 came from, you multiply this 100,000 with 4.5%, but these values, they depend on the book value or the carrying value of the bond. So 104, 100 multiplied by this 4%, 103, 764 multiplied by here 4%. So this came from here, and at the end, this is the plug figure here, because at the end of the maturity it has to be equal to 100,000. So column B is semi-annual interest rate. We calculate like this. Column C, interest expense, which is carrying value multiplied by this market interest rate 4%. So premium is calculated as interest payment minus interest expense. So this 336 will be less from, let me just write it down, minus 336. So this 10764 came from 10, let me write it down here, 104 minus 336, answer would be 103764, right? So you see premium approaches to 0.